Somewhere right now, your bank is making 400 times more money off you than it's paying you back. Not exaggerating for the thumbnail, not rounding up for drama. Yes, 40,000%. You just did what a responsible adult does. You opened a savings account at the big bank where your checking already lives, and then you went and lived your life. Here's the number that should ruin your day a little. Chase Savings, 0.01% APY, verified as of August 3rd, 2026. Bank of America Advantage Savings, 0.01% APY. And this isn't just those two. Many of the nation's largest brick-and-mortar banks pay just 0.01% APY on standard savings. On $10,000 sitting there for a full year, you earn exactly $1. One. You could find more money by accident while looking for the TV remote. You could sneeze near a vending machine and come out ahead. And your bank will still send you a very formal year-end statement to congratulate you on this incredible achievement. Meanwhile, boring, normal FDIC-insured online banks, Markup by Goldman Sachs, Capital One, Barclays, SoFi, the ones you have heard of but just don't use for checking, are paying in the high 3s to low 4s. Same safety net, same money just sits there job description, but a wildly different paycheck. Today, we're doing the math your bank is praying you never do, because this whole thing only works if you assume 0.01% is just what savings accounts pay. Such is not the case. It's what savings accounts pay only when nobody checks.
Let's be clear about the business model, because it's not evil, it's just brilliantly lazy. Your bank isn't holding your money in a giant vault like a cartoon duck. They're renting it out. Your savings become someone else's mortgage at 7%, someone else's car loan at 8%, someone else's credit card at 22% that they will be paying off until their grandkids graduate. There's an actual term for this. It's called net interest margin, the difference between the interest income a bank generates from loans and the interest it pays out to depositors relative to its interest-earning assets. In plain English, it's how much they make lending your money minus how much they pay you for using it. That gap is one of the most reliable profit engines in modern banking, and your low-interest savings account is the cheapest inventory they can get. You are not just a customer, you are their supplier, and they're paying you supplier rates that would embarrass a lemonade stand. So why can big traditional banks get away with it? One word: inertia. You already have a checking account there, so your direct deposit lands there too. Your mom still has that joint account from college linked. Moving your savings feels like a whole weekend project involving passwords, verification codes, and a mild existential crisis. They know this. They had a meeting over this. Someone in a very nice conference room looked at a slide that said, "What if we just paid them almost nothing and they stayed anyway?" And that person got a bonus. Online banks can't play that game. They don't have 4,700 branches, marble lobbies, and free lollipops to fund. The highest high-yield rates are typically offered by online banks because they have lower overhead costs than traditional banks. That allows them to pass savings to you as a higher APY. Let's use real August 2026 numbers, because 400 times sounds like YouTube math until you see it. There are two national averages you will see, and they are both real. They just happen to measure different things. One, the FDIC, which tracks thousands of banks of all sizes, says the national average savings account interest rate is 0.38% APY as of June 2026. Two, Bankrate, which surveys institutions directly, says the national average savings yield is 0.63% APY as of August 1st, 2026. That gap between 0.38% and 0.63% is important. It tells you the average is being dragged down hard by the biggest banks paying 0.01%. The average is not the normal. The average is being held hostage. Now, high yield.
As of this week, NerdWallet's best high-yield savings are up to 4.21% APY. The Wall Street Journal's roundup for August 2026 lists best accounts up to 4.50% APY, often with conditions like keeping $1,500 in a bundled checking account. And that up to 5% number you see in headlines, also real but conditional. After the Fed held rates steady through its first meetings of 2026, top high-yield accounts are still offering up to 5.00% APY as a result. Usually that's a promo rate, or it requires direct deposit, or a $5,000 minimum balance. It's real, but you have to read the footnotes. So let's be conservative and use 4% for math. $10,000 at 0.01% equals $1 per year. $10,000 at 4% equals $400 per year. Same risk, same FDIC insurance of up to $250,000 per depositor per FDIC-insured bank per ownership category, same liquidity. The only difference is the logo at the top of the login page. $400 versus $1 isn't an optimization, it's a typo correction. And it scales in the worst way. It punishes people who actually did the responsible thing and saved. $20,000 at 0.01% equals $2 per year. You can't buy a coffee with that interest. You can stare at a coffee and think about it, though. $20,000 at 4% equals $800 per year. That's a flight, or a new tire, or 200 coffees you actually get to drink. One more detail your bank won't put in a commercial. These rates move with the economy, but not equally. Online banks generally track the Fed closely. Big banks don't practice that so much. After the Fed lowered its benchmark rate a total of 75 basis points in 2025, officials have kept rates steady through 2026, including the July meeting. High-yield accounts stayed high because banks have to compete. Big banks stayed at 0.01% because, why wouldn't they? You haven't left yet. And a quick footnote for the comment that says, but Bank of America pays more if you're rich. Technically, yes. If you have $1 million parked daily, you unlock Diamond Honors and get a whopping 0.04%. That's still 10 times less than the national average of 0.38%. Congratulations on being punished for loyalty at scale.
Brain excuse number 1. Online banks are sketchy. Nope, if it's FDIC-insured, it's FDIC-insured the same. Chase fails, you're covered up to $250,000 per depositor, per bank, per ownership category. Marcus or Capital One fails, exact same coverage. It's not a riskier product. It's the same product sold by a company that didn't build a fish tank in every branch. Brain excuse number 2. Those high rates are just bait and switch teasers. Sometimes this one is actually true, which is why we check. Some accounts advertise 4.85%, but it's tiered. 0.25% on the first $4,999, and then 3.75% on $5,000 plus. Or it's 4.21%, but you need $1,500 in checking. That's a real pattern, not paranoia, and big banks love that you believe it because it keeps you at 0.01%. The fix is boring. If the rate has an asterisk, it has a story. Ignore the headline, check if it's on the full balance with no minimum. A boring verified 4.10% on your full 10K from Marcus or Capital One beats a flashy 5% on $500 every time. Brain excuse number 3. But I like having a branch to walk into. Totally valid, and you should keep one. No one is saying close your big bank and live in the woods with a fintech app. Physical branches, instant internal transfers, same-day cashier's checks, talking to a human when you lost your card in another country, that convenience is real. It's just not worth $400 a year per $10,000 to keep your entire savings there. You're paying a $400 annual fee for occasionally looking at a marble lobby.
This is not all or nothing. You don't need to become a spreadsheet guy with 14 savings buckets. Step 1. figure out your oh crap buffer, roughly 1 or maybe 2 months of core expenses, rent, groceries, insurance, the number you'd need same day with no waiting. Leave that in your big bank. That covers overdraft protection, emergency, ATM cash, and instant transfers. Step 2, everything above that buffer is currently working a second job for your bank's CEO. That's what moves. Opening a high-yield savings account takes about 10 minutes. Link your existing checking, push the excess over. No fees to open at most reputable online banks, no minimums at many. Money is still liquid, and you can pull it back anytime. It just takes a day or two via ACH instead of instant. Before you click Open, run the 3-second scam check. Is that APY on the full balance, or is it 5% on up to $1,000, then 0.5% after? Is there a minimum to earn the advertised rate? Some say 4.10%, but only if you keep $5,000 plus in there. Check also for monthly fees, because a $5 monthly fee wipes out $60 a year. If you only have $1,000 saved, your 4% gain was $40, and you just paid $60 for the honor. Once it's done, set a calendar reminder for twice a year. Rates are variable. The Fed will eventually cut again. When it does, your high yield will drift down a bit, but your big bank will stay exactly where it is, at 0.01%, because 0.01% isn't tied to the economy, it's tied to optimism that you won't check. So here's the actual picture. No one is stealing from you. There's no line item that says, sneaky fee $3.99. There's no lawsuit here. It's just a system that quietly depends on you assuming all savings accounts pay basically the same thing. And it works because most busy, normal, responsible people never compare the number on their statement to what's actually available. Here, we don't have any affiliate links. No bank is paying us to tell you all this. We don't have any horse in this race, so we don't care which high yield you pick. We just want you to make your money work for you, like it does for the banks. Sources for everything in this video, FDIC data, Bankrate, WSJ, and NerdWallet August roundups, all with dates, are in the description, so your group chat can't fight you on it. And send this to the one person you know who still says, my savings is fine, it all pays the same anyway. If you want us to keep finding the next one, like and subscribe. New videos every week. Finding the money hiding in plain sight. This is the Quiet Markup.